Observing the bustling trading floors of major financial centers reveals a profound transformation in modern wealth preservation. Market participants are increasingly shifting their focus away from conventional paper assets. This vital transition is most visible within the precious metals sector, where physical accumulation now dictates entirely new global pricing structures. The massive influx of Chinese capital into the global gold market has fundamentally altered established economic paradigms. For decades, the international price of this precious yellow metal was heavily dictated by Western financial institutions. Now the relentless Eastern demand has successfully overpowered the traditional pricing mechanisms of the Western world. Historically, gold prices moved inversely to American interest rates and the strength of the dollar currency. When rates increased, Western investors would quickly abandon their metal holdings in favor of yielding bonds. This predictable correlation formed the absolute foundation of standard macroeconomic forecasting models used by countless financial analysts worldwide. That historical relationship has completely broken down during the recent economic cycles observed across global markets. Despite rising interest rates in the United States, the value of bullion continued to climb steadily higher. This unprecedented decoupling has left many traditional economists completely baffled by the immense strength of the market. The primary catalyst for this profound structural separation is the overwhelming volume of Asian capital inflows. Chinese buyers are no longer waiting for favorable macroeconomic signals from Western central banks before accumulating assets. Their purchasing decisions are driven entirely by localized economic conditions and severe domestic wealth preservation strategies today. Speaking as a market analyst, the behavioral shifts among global central banks are truly remarkable to observe. The People's Bank of China has aggressively led this unprecedented wave of sovereign physical accumulation efforts. Their continuous monthly purchases demonstrate a clear strategic intent to heavily diversify away from dollar-denominated assets. This relentless central bank buying is deeply rooted in profound geopolitical concerns rather than simple financial speculation. Sovereign nations are witnessing the aggressive weaponization of traditional Western monetary systems and payment networks globally. Consequently, acquiring physical bullion stored within their own borders provides ultimate security against future international financial sanctions. The sheer scale of these sovereign purchases effectively creates a solid permanent floor beneath global trading prices. Whenever Western institutional investors attempt to trigger massive market sell-offs, the central banks quickly step in. They gladly absorb the excess liquidity, essentially punishing Western traders who bet against the precious metal markets. Analyzing the contrasting behavior of global retail investors reveals another deeply fascinating layer of this financial divergence. Western exchange-traded funds have experienced massive continuous outflows for several consecutive months across major exchanges. European and American investors rapidly liquidated their physical-backed funds to chase higher-yielding stock market returns. In stark contrast, Chinese domestic markets witnessed an unprecedented explosion in demand for similar precious metal vehicles. While Western financial capitals were busy dumping their institutional gold positions, the Eastern markets eagerly absorbed them. Chinese exchange-traded funds recorded truly historic inflows, completely negating the massive selling pressure originating overseas. This incredible divergence highlights a fundamental misunderstanding of wealth preservation among different global economic participants today. Western investors predominantly treat the precious metal as a simple tactical trade. They constantly rotate their capital based on short-term inflation expectations and yields. Consequently, their commitment to the physical asset remains incredibly weak. Meanwhile, the Chinese investment strategy revolves entirely around securing generational wealth against systemic domestic economic uncertainties. Local property markets remain deeply troubled, while traditional stock exchanges offer very little confidence to buyers. Therefore, ordinary citizens are desperately seeking highly reliable alternative vehicles to actively protect their hard-earned personal savings. The Western hoarding mentality historically relied on anticipating extreme disaster scenarios or sudden catastrophic market collapses. American survivalists often purchase physical coins, primarily to prepare for apocalyptic events or total currency failures. This highly pessimistic approach severely limits the broader mainstream appeal of accumulating precious metals within Western financial circles. Conversely, the modern Chinese approach integrates gold seamlessly into everyday rational financial planning and conservative saving. Young professionals are increasingly purchasing small physical beans every month as a disciplined mandatory savings routine. This pragmatic strategy transforms the asset from a fringe survival tool into a highly respectable mainstream financial instrument. Market sentiment plays an absolutely crucial role in generating the current massive waves of global liquidity. Traditional safe haven demand typically surges only during times of acute, international military conflicts or crises. However, the current Eastern buying frenzy is heavily fueled by a prolonged structural lack of alternative investment options. This lack of alternatives creates a self-fulfilling prophecy of rising prices driven by sheer liquidity. As more domestic capital desperately chases a strictly limited supply of physical metal, the local premium increases. This elevated domestic pricing ultimately forces international arbitrageurs to physically move massive quantities of bullion into China. The immense psychological impact of constantly breaking new historical price records cannot be underestimated by analysts. In Western markets, record high prices typically trigger massive profit-taking and aggressive institutional short-selling. However, in Eastern cultures, rising valuations frequently validate the underlying investment thesis and encourage even more aggressive purchasing. We must carefully analyze how this specific psychological divergence fundamentally alters the global supply chain mechanics. Swiss refineries are currently operating at maximum capacity simply to melt down large institutional delivery bars. They must urgently recast them into smaller kilobars, specifically designed to satisfy the insatiable retail demand from Asia. This massive physical transformation represents a permanent migration of wealth from the West to the East. Once these precious metals enter the mainland market, they very rarely return to Western financial vaults. The capital controls implemented by the government ensure that domestic gold remains securely trapped within the local economy. Such strict capital containment policies perfectly align with the broader strategic objectives of the central bank. By actively encouraging private citizens to accumulate physical bullion, the state essentially crowdsources its national reserves. This incredibly brilliant strategy significantly enhances the overall financial resilience of the entire nation against external economic shocks. Furthermore, the persistent local premium heavily incentivizes international mining companies to bypass traditional Western trading hubs. Resource producers increasingly prefer to sell their freshly mined products directly into the booming Asian markets. This direct supply route slowly starves the Western exchanges of the crucial physical liquidity required for normal operations. This ongoing drain on Western physical inventories leaves international paper markets highly vulnerable to sudden shocks. Trading massive volumes of unbacked futures contracts becomes incredibly dangerous when the underlying physical metal vanishes. Consequently, Western market makers are now forced to permanently adjust their complex pricing models to reflect this reality. Many prominent financial commentators still incorrectly attribute the recent price rallies to simple speculative futures trading. They completely fail to recognize the massive structural shift occurring beneath the surface of the market. The sheer tonnage of physical bullion successfully moving eastward cannot be dismissed as mere temporary statistical noise today. This relentless Eastern bid essentially neutralizes the traditional monetary policy tools used by the Federal Reserve. When American central bankers forcefully attempt to cool inflation by raising interest rates, the metal ignores them. The overwhelming physical demand from Asia completely absorbs any institutional selling pressure generated by higher Western bond yields. Therefore, the precious metal has effectively declared its independence from the American dollar and associated yields. It is now trading fundamentally on its own merit as the ultimate sovereign reserve asset globally. This marks a profound paradigm shift that will dramatically reshape international financial architecture for many decades to come. The separation of international pricing from traditional macroeconomic indicators heavily frustrates legacy portfolio managers and traders. These professionals spent their entire careers mastering complex mathematical correlations that no longer accurately describe reality. They watch in total disbelief as their perfectly calculated short positions are repeatedly crushed by massive Eastern buying. Understanding this monumental shift requires observers to completely abandon their deeply entrenched Western financial market biases. One must view the global economy through the strategic lens of emerging markets and sovereign nations. To them, the dollar is increasingly viewed as a highly politicized instrument rather than a neutral reserve currency. This growing distrust of Western financial hegemony directly fuels the relentless demand for independent tangible assets. Gold represents the ultimate decentralized currency, holding no counterparty risk and requiring no third-party validation. Therefore, it perfectly serves the strategic defensive needs of nations, actively seeking complete financial sovereignty and absolute independence. The domestic retail enthusiasm across the mainland further amplifies this broader sovereign defensive strategy very effectively. Citizens intuitively understand that possessing physical wealth protects their families from unpredictable currency devaluations and inflation. This ancient cultural wisdom is now being executed using modern financial infrastructure like mobile banking and digital platforms. Consequently, the rapid digitization of bullion purchasing has completely democratized access for ordinary citizens across Asia. Retail buyers can instantly acquire fractional quantities of physical metal using their smartphones with ease. This frictionless user experience generates a massive continuous stream of steady microtransactions that collectively overwhelm global markets. Western investors must urgently reconsider their fundamental understanding of how global liquidity presently operates and flows. The traditional assumption that Western financial capitals unconditionally dictate global asset valuations is now dangerously obsolete. Asian wealth centers currently possess the necessary capital and strategic discipline to fundamentally command international precious metals pricing. The persistent outflows from Western physically backed funds clearly illustrate a profound loss of regional confidence. European portfolio managers mistakenly believe that yielding assets always provide superior protection against persistent systemic inflation. This fundamental miscalculation leaves major Western institutional portfolios dangerously exposed to sudden currency shocks and sovereign debt crises. Conversely, the incredible resilience of Eastern domestic demand demonstrates a deeply profound understanding of monetary history. Asian investors recognize that fiat currencies eventually succumb to the relentless mathematical pressures of sovereign debt. Therefore, they willingly pay significant local premiums to successfully exchange their rapidly depreciating paper money for timeless physical money. This strategic exchange is highly visible in the unprecedented volume of physical imports entering the mainland. Customs data consistently reveals massive shipments arriving from major global refining hubs directly into the country. These enormous physical deliveries definitively prove that the reported domestic purchasing volumes are entirely genuine and structurally massive. Market analysts frequently debate whether this incredible Eastern buying wave will eventually subside or lose momentum. However, the underlying structural drivers compelling this massive wealth transfer show absolutely no signs of abating. Geopolitical tensions remain incredibly high, while sovereign debt burdens continue expanding exponentially across all major developed Western economies. Under these highly volatile global conditions, the rational response is to accumulate unencumbered physical reserve assets. The central bank clearly recognizes this mathematical reality and aggressively executes its long-term strategic mandate. Their monthly purchasing announcements consistently provide tremendous psychological support for the entire domestic retail investment sector every time. The sheer predictability of these official sector purchases introduces a completely new dynamic to market forecasting. Institutional short sellers are incredibly terrified of accidentally stepping in front of this massive sovereign bulldozer. Consequently, the traditional speculative shorting mechanisms that previously suppressed prices are now completely broken and entirely dysfunctional today. This dramatic reduction in speculative suppression allows the true physical fundamentals to finally dictate asset valuations. The resulting price discovery process is brutally honest and frequently highly painful for Western paper traders. They are slowly realizing that unlimited printed currency cannot infinitely suppress the value of strictly limited physical resources. The fascinating evolution of wholesale jewelry demand provides another critical perspective on these shifting market dynamics. While traditional ornamental purchases have slightly declined, the investment-grade jewelry sector is experiencing explosive growth. Consumers demand pure solid pieces that function simultaneously as beautiful wearable art and reliable long-term financial protection. This blurring of the line between luxury consumption and financial investment is a distinctly Eastern phenomenon. Western consumers typically separate their discretionary luxury spending entirely from their serious retirement portfolio allocation strategies. However, Asian buyers brilliantly combine both concepts to successfully maximize the utility and security of their personal wealth. The resulting structural transformation of retail inventory is deeply challenging traditional luxury brands operating in Asia. They must rapidly adapt their product lines to offer significantly higher purity items to remain competitive. Consumers completely refuse to pay massive designer premiums for alloys that lack substantial intrinsic value and lasting security. This uncompromising focus on strict intrinsic value serves as a powerful testament to changing consumer priorities. The era of frivolous discretionary spending has abruptly ended, entirely replaced by a highly defensive mindset. Every financial decision is now carefully weighed against the overarching necessity of preserving purchasing power against future inflation. Global precious metals analysts must carefully study these profound behavioral changes to accurately predict future trends. Ignoring the massive psychological differences between Western speculators and Eastern accumulators leads to disastrous analytical errors. The future of the market belongs entirely to those who deeply understand the structural power of physical possession. Furthermore, the increasing geopolitical fragmentation of the world actively accelerates this massive shift toward tangible assets. As international trade routes become increasingly hostile, nations desperately need universally accepted collateral for sovereign settlements. Physical bullion perfectly serves this critical function because it entirely sidesteps the heavily monitored Western international banking infrastructure. Therefore, the relentless Eastern accumulation is fundamentally a massive strategic preparation for a multipolar financial future. The current financial architecture, dominated by a single Western currency, is rapidly fracturing under immense pressure. Emerging economies are brilliantly positioning themselves to successfully thrive within a completely new decentralized global economic trading paradigm. The massive liquidity wave generated by domestic retail investors ensures this transition occurs relatively smoothly locally. By heavily absorbing global physical supplies, they successfully insulate their domestic economy from external currency volatility. This remarkable synergy between sovereign strategic goals and private wealth preservation creates an incredibly powerful, unyielding market force. Western economists often dismiss this massive accumulation as an irrational cultural phenomenon driven by outdated traditions. This arrogant dismissal completely blinds them to the brilliant economic rationale driving the relentless Eastern bid. Protecting sovereign wealth from predatory inflation and foreign confiscation is the most rational financial strategy imaginable right now. The decoupling of precious metals from Western interest rates is simply the first symptom of this shift. As the profound structural migration of physical wealth continues, we will witness further unprecedented market anomalies. The traditional financial textbooks are currently being completely rewritten by the unstoppable massive force of Eastern capital flows. In conclusion, the global pricing mechanisms have been permanently altered by this magnificent Eastern wealth transfer. Western financial capitals have completely lost their historic ability to dictate the value of physical money. The center of gravity for precious metals has successfully and irrevocably shifted toward the booming markets of Asia. The relentless domestic demand for exchange-traded funds perfectly mirrors the aggressive sovereign accumulation happening concurrently. Together, these two massive forces create an absolute impenetrable fortress of financial security for the nation. This brilliant defensive strategy guarantees their long-term economic survival, regardless of future Western monetary policy decisions globally. Market observers must firmly acknowledge that the current liquidity wave is fundamentally different from previous cycles. Historically massive price spikes were quickly followed by devastating crashes once the underlying geopolitical panic subsided. However, the present accumulation phase is driven by permanent strategic necessity rather than temporary emotional market panic alone. This permanence completely redefines the concept of a safe haven asset in the modern global economy. It is no longer just a temporary shelter from violent financial storms originating in Western markets. It has successfully evolved into the permanent foundational bedrock of an entirely new independent Eastern financial architecture today. The sheer magnitude of Western fund outflows perfectly highlights their fatal reliance on unbacked paper promises. European investors eagerly traded their absolute financial security for the temporary illusion of higher stock yields. They will inevitably regret this massive historical miscalculation when the next inevitable global sovereign debt crisis finally erupts. Meanwhile, Chinese investors will comfortably weather the coming economic storms securely anchored by massive physical holdings. Their disciplined approach to continuous fractional accumulation has brilliantly secured their families against future financial ruin. This profound generational wisdom stands in deeply stark contrast to the reckless short-term speculation defining Western markets. The central bank acts as the ultimate guarantor of this magnificent national wealth preservation strategy globally. Their massive official purchases provide immense validating confidence to the entire domestic retail consumer market constantly. This beautiful symbiotic relationship between the sovereign state and private citizens creates an absolutely unbreakable financial defensive shield. Financial historians will eventually look back at this specific transitional period with tremendous absolute awe. They will thoroughly document how a brilliant coordinated strategy successfully defeated entrenched Western financial market manipulation. The peaceful silent transfer of global physical wealth will be remembered as a truly masterful economic strategic victory. For current market participants, the immediate lesson is abundantly clear and absolutely mathematically undeniable right now. Betting heavily against the relentless Eastern physical demand is a guaranteed path to severe financial destruction. The global market now entirely belongs to the patient-determined accumulators who deeply respect actual physical intrinsic value. The previous reliance on macroeconomic indicators like American inflation data is now a completely pointless exercise. The true fundamental price driver is the simple mathematical reality of massive physical supply shortages globally. When immense Eastern capital heavily targets a strictly limited physical resource, the fiat price must rise absolutely exponentially. This magnificent price trajectory will continue regardless of whatever minor policy adjustments the Federal Reserve implements. Western central bankers are completely powerless to stop a sovereign wealth transition of this immense historical magnitude. Their only remaining option is to quietly watch as the fundamental global financial order is permanently rewritten forever. Ultimately, the massive wave of Chinese capital has successfully restored honesty to the precious metals market. The artificial paper pricing structures that dominated previous decades have been completely shattered by physical reality. The true independent value of sovereign money is finally being correctly established by the free global physical market. Looking ahead, the absolute structural permanence of this massive Eastern demand presents incredibly profound global implications. Developing nations worldwide are carefully observing this highly successful strategy of aggressive national physical wealth accumulation. They will inevitably replicate these brilliant defensive tactics, thereby accelerating the total global transition away from dollar dominance. The final analysis of this unprecedented economic phenomenon requires absolute intellectual honesty from global market analysts. The complete decoupling from Western macroeconomic factors is not a temporary market anomaly or a fleeting statistical error. It is the permanent, brilliant triumph of tangible physical reality over decades of reckless Western fiat currency experimentation.